Okay, good afternoon, everybody. This is Johnny Seville from Acorn Wealth. Um, Welcome, everybody. Can everyone audio coming through clearly? Let's get a yay. Yay, if it. Okay, perfect. Wonderful. Well, welcome everybody, and welcome to the DNA of technical trading. You'll have to excuse if I'm a little bit muffled today. I actually just had my four wisdom teeth taken out, and what an unpleasurable experience that is. I probably should have had it done when I was a young guy, or at least in my 20s, but um, leaving it till now, unfortunately. Yes, ouch. Um, but we do have a wonderful program planned for you this afternoon, which is the DNA of technical trading. And this is a quite an exciting topic that I like to talk about because it basically builds the all of the structure in the market from top to bottom that we like to follow on a day-to-day basis. Let's start, of course, with the standard disclaimer. Acorn Wealth Corp is an educational company specializing in strategies for publicly traded stocks and options. And of course, this is not a recommendation to sell any of the securities discussed. Options trading and stock trading does involve lots of risk, and you can lose all of your money. So please take into requirement your own risk profile before taking anything into action. Okay, so the today, what I'd really like to be able to share with you is something that I find one of the most important foundations to everything that we do. And in this kind of industry, there's always a race to develop the next best indicator or the next best trading system or the next best scan or the next best thing, and I get it. And we all like to have the newest best toy. But one of the things that I found in having teaching trading now since 2007 and in the trading industry myself full time 2001 uh, is that simplicity of something that works is often the most important thing before we go any further. Um, And when we talk to a lot of the students that we've studied with over the last decade and asked them, when they came to us, what were the key things that they struggle with? It's often some of the same things. It's, knowing exactly when to get in and when to take profit too early before a stock takes off. So you get into the stock, you're up 10%, you go, great, I'll take it. Then it goes up another 30%. Or knowing when to limit losses and avoid holding on way too long in the opposite direction. And often these sometimes go hand in hand. I've seen this time and time again where, in fact, a lady I was talking to recently did this exact thing. She was getting it right. 70% of her trades she was getting right, 65 to 70% of her trades. But she was losing money. And I said, well, how is that possible? And I went down and sat with her and did a one-on-one training session with her. And I looked at all these different trades, and what she'd done was on her first couple, it was like a gold play, a Lululemon long, and something else, all of which went straight down. She had no plan, or if she had a plan, it wasn't set in stone. So she just let them drop and let them drop and let them drop, and then all of a sudden she did what every trader has done at least once in their career. She said, "Well, now I'm going to turn these into a short-term trade, into a long-term hold." Right? Um, those terrible words. And so because she was so now gun shy of the losses that she had, what she would do is with the longs that she took that was successful, as soon as they went up 5%, 10%, she was cutting them short as soon as she had profit because she was so nervous of losing money. So basically, it was this kind of micromanaging her strategy, constantly changing what she was going to do to execute because she didn't have the confidence anymore. And as a whole, I think it's a good example of where most people are at or have been at least one point in their career. is that they fail because they do not have rules um, or confidence in them. What we're going to talk about today is the idea of putting in place these very structured and systematic systems, essentially, where we stop asking ourselves, uh, "Gosh, are we right or wrong?" and replace that much more importantly with the question of or not, and not having to check all those different extra resources or what Kramer's saying or what the news is saying, but simply say, what does the system tell us to do here? So the key thing that with any trade that we try to approach it with is that we should always take calculated risks, but that is very different from being rash. Um, so how do most people make their decisions here? I'd assume that obviously you've all had some great studies being a part of the Cyber Trading University group and Fausto's teachings. Um, out of the strategies you've learned so far, what if we were to sit down together right now and say, right, what stock should we buy tomorrow? How would you go about how to start that process to say, right, what would be the best possible opportunity to trade tomorrow? What would you start off by doing? Scan the news? Yeah. Well, I mean, day trend, 1 day trend. Okay. Well, I mean, a lot of people kind of get their ideas from several groups. Either it's news, friends, newsletters, or things that they're familiar with. And of course, at the end of every webinar I ever host, people always ask those same questions. What do you think of Netflix? What do you think of Tesla? What do you think of Microsoft? What do you think of Apple? Are these the best stocks to trade? Most of the time, no. But people like to trade them because it's what they're familiar with. So anyway, what we want to try and replace that with is is a set of variables or a system, a machine that we can churn ideas through that are going to give us the highest probabilities for success and eliminate the things that provide us low probabilities of success, which is emotional decision making of failing to limit losses, averaging down, buying into emotion, and so forth. Okay, all these things which are human problems, which is perhaps why you see 95% of people lose. 95% of investors aren't bad. They're not bad traders or bad not intelligent people. It's just that they invest emotionally. That's what fills their gaps. And the market knows exactly how to take advantage of those people without strategies, how to whipsaw them at the worst times. And that's where the job of the market comes in. The market makers playbook, or the job of market makers, is to constantly keep you on your toes, uh, to constantly make do the worst thing at the worst time. So you'll see news of stocks crashing, market meltdown, all those types of things. Whenever you read that, that's usually the best day to buy stocks. And then the same on the flip side, when we start to see euphoric markets, the Trump rally is going higher and higher and higher. People leaping into stocks. Yep, usually a great time to short. Um, so what we need to do is get away from all of the fluff, all of the subjective information there, and try and strip it down to the core concepts of right. What actually? How does the market actually work? And then let's reverse engineer that to find where the big players are. And that's the opinion that I am most interested in. I don't care what John Dent says, or Harry Dent, or Trump, or Obama, or any talking head. What I want to know, and especially not my own opinion, that's the least of them, of the most important ones. What I'm concerned with is what is the opinion of the people that drive the market, those underlying forces. So firstly, let's look at the way that um, market structure works. Firstly, we've obviously got three types of directions. Pretty simple: up, down, and sideways. And the traditional definition of that is market is highs and lower lows. And a sideways market, which is often referred to as range bound, is where a stock will oscillate back and forth in a channel with no real indication of a general direction at all. Now, these are the basics, but obviously, when we go into the business of trade, be able to have an opportunity or a strategy to be able to trade all three conditions. Okay, all three conditions. Because if you're only trading long, you're only making money a third of the time. If you only trade short, only making money a third of the time. Why not make money in all three conditions? Because no matter what type of investment vehicle you have, you can still trade long and short, even if it's in inverse ETFs or things like that. Okay, let's move on to something a bit more exciting. Everyone knows the three directions, but not many people are as familiar with the concept of the three different market cycles. And when I say market cycles, what I mean is there are these three different personalities of how a market, a stock, an index can move. The first of which is oscillating. Now goes back and forth within a restricted range. And what restricts the range are straight or static lines that pretty much encompass the entire movement of that stock up and down, with very few times it actually breaks above or below. When we see that, we can notice oscillation. The next type of pattern is we look at consolidation. Now, this also is a type of oscillation because we are, again, what restricts this from moving, or what makes this go up or down, once again, is two straight lines, which contains the entire system of that stock. Once we break out of that zone, then we take on the third characteristic of a personality type of a stock, which in this case is momentum. And when the stock moves on to a momentum type trade, this is then when we get a completely different set of rules altogether. Now the straight lines are not the ones controlling where the stock goes. It is the moving averages above and beneath that tame the beast of this stock's chart. And this is absolutely one of the most important things you have to do when you first look at a chart if you want to be able to consistently make money, is to be able to look at that chart and say, right, what support and resistance matters to this stock? So how many people are very familiar with this, and how many people are new to this idea? Because I asked this because this will give us an idea of how much time to continue coming back to this topic as we go through the webinar. New? Okay. New? All right. So let's talk a little bit more about this then. This is so important because when you look at a chart, you need to determine what kind of animal it is. What support and resistance matters. Let's use an example. Okay. Let's use an example. Now this stock is a CORT. So let's do kind of understanding patterns and probabilities, lesson 101. When we look at a chart, the very first and most important thing we need to do is figure out how does it behave? Like studying an animal. How does it behave? How does it move? And so before you add any kind of special whiz-bang techniques to the chart, your job is to determine where is support and resistance. Because support and resistance is what makes a stock go up or down and is therefore where you would buy or sell your trade. When we look at this company CERS, this therefore brings up the first most important thing I want to teach you today, which is how do you draw a trend line. So a lot of people make a critical mistake when they bring up their chart and they do this. They go, support. They'll connect the right to the left. Or maybe they do this. They'll just find a point that they think looks about right and they do that. Or maybe they don't do that. Maybe they do this. Right? Or maybe they say, well, hang on, maybe it's not that. Maybe it's something a bit more like this. Or what if it's not that at all? What if it's something like this? You see what I mean? How many people struggle from this? I think so many people I've met, this has been one of the, everyone knows what support and resistance is, but whether you actually draw it properly is a totally different thing. This is one of the most valuable and most important skill sets that you should have right if you're going to trade stocks or options or futures, because this gives us the roadmap of what the stock is doing. And there is a right and wrong way to do it. So basically, what we do, the very first rule when we look at a chart, is we need to determine what support and resistance works for this chart. Try and identify an obvious pattern. So what we do is we go back as far as we need to. That might be 3 months, it might be 6 months, it could be 12 months. But we go back as far as we need to until we can find, essentially a chart pattern that jumps out to us. Now, when I look at this, I can see there we go. Now, by doing that, I have cut this candle out of the equation. So that is not valid. So I tighten that up. I go left to right, and I have now located the first possible trend line. What I would then do is automatically duplicate that beneath and look for any kind of confluence, anything else that's matching up with that. And that's pretty weak. You see that it's not really very, very strong. More likely, we have something else. Now, as we start to adjust these levels, the actual pattern that seems to be the most obvious that jumps out to me would be this. A declining neckline, head and shoulders. And you can see if we go down to the bottom, marry that up. There we have it. And we can look at that was where the gap up was, pulled back, rallied up to resistance, down, gap down, continued down to support, rallied up to resistance, pulled back, shot straight up. We've had some very aggressive movements at these levels. And what this allows us to say is we have a potential downward neckline head and shoulder pattern. By knowing that it's oscillating, we can therefore choose what type of rules to look for on it and how we might go about trading it. Okay, same thing is another stock. This would also be an oscillating trade. Now, let me show you a quick example of this type of an oscillating pattern. If I was to bring this stock up in front of you, and I was to say, hey Greg, hey Pamela, hey John, you know, this looks like a great short to me. How many people here in the room would look at this chart and say, you're stark raving mad, John? No way, I would not short that. Yeah, probably a few people, wouldn't you? You'd say, that's nuts. It's going straight up. That looks bullish as hell. But when we start to apply the rules of an oscillating trade, we start to change our opinion. And remember, this is the focus of having a strategy. What we need to do is we need to say, regardless of the emotions when you look at this and say short it, give you the heebie-jeebies, right? Gosh, no. Why would I do that? That's crazy. But then we look at the rules. We say, okay, well, this stock has had a very dramatic rally from 350 all the way up to almost $10. You'll note that every time it kind of rallies, it it is moving sharply upwards, not as if it was following a nice, gentle moving average. The moving average, in fact, if you look at the 9-day and the 20-day moving average, they don't really work at all. They kind of cut through the middle of the stock. They cut through the middle of the stock because a momentum stock does not follow, an oscillating stock does not follow moving averages. So if you're dealing with an oscillating stock, moving averages do not work. So forget those. So we know that the stock is oscillating, A, because it's not working with the moving average for one. And just by the looks of the trade, you can see it's very erratic. So what we do is we say, well, this stock is due for a pullback at some point. So let's add our first rule for an oscillating trade. One of the first things that we look for, if a stock is oscillating, is we look to see if the stock was above, if the stock is above the upper Bollinger Band. And you can see here the stock has clearly crossed above the upper Bollinger Band, meaning that there is a 94% chance it will go back inside it. Now, that doesn't mean that it's going to be a massive drop. It could at least just be a small pullback before going higher. But now we know that that characteristic on an oscillating trade is telling us down. And what we then do, we go next. Let's have a look at other oscillating indicators. We look at the RSI. Now the RSI, if we were in a momentum trade, right? If we were dealing with momentum, we would be buying when the stock's RSI went up over 30. We get confirmation when the stock's RSI goes over 50. Yep, great. Stock Stock trading 101. But if we're dealing with oscillating trades, we want to short that stock when the RSI is as close to 100 as possible. And we want to go long in an oscillating trade when it's as close to 0 as possible. And when you see the RSI up over 90, that's a big check mark in that direction. So we then go one step further. We can have a look at CCI. Also a oscillating only indicator. And what you can see here is we're looking for this level to be up around that 200 level or above, which it is as well. So we have basically several indicators all saying that this is overextended. But that still isn't enough, because all those indicators tell us is the symptoms of the stock's chart, that the stock is overweight. The stock wants to retrace. But what it doesn't tell us is when and how far and how powerfully. And that's when we come back to our rules of looking for support and resistance. When I took a gander at this stock, and I looked at my left to right analysis of this chart, I could see that there was a very strong, unbroken, powerful resistance level that had been climbing up along this chart since August 2013. And so that, my friends, made it a yes right there and then. Right at resistance, with an opportunity for it to drop at least back down to that 750 range, possibly lower. And we could see it was right at that level. Therefore, because we were looking at an area with a high probability of a breakdown, we then get a different type of entry point. We can enter on the way up. So we're essentially shorting at 973 and then putting a stop criteria at 1013. Your risk then becomes what? Maybe 40 cents. But your target from 973 to 8 to 750, right, is $2.20. So now you've got a risk reward ratio of 5 to 1. 5 to 1. So you do not any longer have to worry. So now, so the emotional trader says, okay, I don't know if I can do that because I'm going counter trend. I need to wait for confirmation. You absolutely don't. A good trade is about whether it meets the pattern, whether it meets the rules. And when we start to look for what those rules mean and how we trade them, it gives us a whole nother level of rule book to start to look at. So think about those three things once more. So essentially what I've told you is that if you're dealing with an oscillating stock, moving averages don't work. The most important thing to look at is what horizontal or diagonal lines do. Locate them. Once you've drawn those on the chart, you'll then be able to see what pattern it is. And once you know the pattern, then and only then will you know how to trade it. It's the only rule-based charting that works well that I know. If we're dealing with momentum, then we don't worry about the horizontal lines above us because the momentum is more powerful and it will break through those. And again, we look for those momentum patterns. So when you sit down at night, this is the question I want to put out to you all. If we were to sit down right now and say, okay, write down for me exactly what you want me to find for you to be a perfect trade. What is your business plan? Like just like if I went into Steve's gym and I said, "Hey, if I could bring you 100 new potential customers tomorrow, who would they be?" He would know exactly who those people would be. You know, if you're in the business of trading and you're looking for candidates for your business, what is the resume of the perfect stock for you to trade? What would that look like? Do you know it? Or maybe are you still figuring it out? Most people don't know. Most people don't know, which means that without a strategy, you go back to the old saying, if you don't know where you're going, then any road will take you there. And this is why we need to start breaking down into how important these patterns are to build a strategy from. So let's go to the next level of depth. Now we know that these days, who moves the market? What ultimately moves the market? Volume. Volume moves price. So if volume dictates price, then who dictates the volume? Well, they estimate that anywhere between 80 to as much as 95% of the market's volume comes from high frequency traders. So when you start to combine those two things, it becomes even more amazing. And the way that these market makers make decisions is by going through a playbook. Okay? So they're going to say, right, think of it like football. You got football players on either field, the whistle blows, someone grabs the ball, and all of a sudden you got tons of people running across in different directions at each other, slamming into one another, kicking each other down to the ground. And my first football game, I looked at this and thought, what the hell is going on? This is chaos. How does anyone understand this game? And the more and more I watched it, the more and more I saw that there was a method to that madness. There was structure and organization to that madness. And so I likened this immediately to the stock market. Basically, in the stock market, there are approximately just over 100 different patterns that the market will go through. So when you have this 85 or 90% of the volume being controlled by algorithms, they're controlling the market by cycling through play by play by play by play. And what we need to do is define how those plays work. Oops, right? So firstly, we've got oscillating plays. That's going to be one big group. Second, we're going to have momentum plays. We talked about that. Very different from oscillating. You do use momentum indicators there, like the MACD, moving averages. And then once we've been able to get an idea of what we're looking for, then we can start to scan for it. All right. Now, how many people here use scanning already? Yep. Good. Okay. So let's talk about what we look for in a scan. Now, the highest probability, the first thing we do is look at where the market's at. If we're going to understand patterns and probabilities, the first thing we should do is look at where the market's at. There's the S&P 500. Let's do our top-down decision making. All right. Firstly, the S&P 500 was stuck in a downward channel since August, basically onwards. We've bounced back and forth, back and forth, back and forth. We've then broken out. And where do we break to? Well, we measure the distance between the bottom of the channel to the top of the channel. There it is. Bottom of the channel to the top of the channel. That tells us how far the S&P 500 should be able to get to before it hits significant resistance. That's where we're at right now. So we're waiting to see what occurs next, whether we go higher than this range or whether we break down. But right now it's indeterminate with a slightly stronger bias to the bullish side instead of the negative bias. Okay. That's what the pattern tells us. We're exhausted from the bullish nature of this until we form a new pattern. Let's have a look at the macros on the S&P 500. Okay. Now, if we look at the macros, we see something a little bit different. We look like we've got some kind of we've got an upward channel form back here that we've broken down from, and we're forming what looks like could be a messy kind of head and shoulder pattern. But not yet confirmed on the drop side. It's teetering up here, but looking for that drop to occur. So right now we're kind of in a critical a critical time for the S&P. What's a macro of S&P? Shorter time frame? No, a macro would be a larger time frame. Okay, moving along. So if we're in a bullish market, if we are in a bullish market, what do you think? And we're looking for shorts. What is the number one ranking pattern for looking for shorts in a bullish market? What is the number one best pattern for looking for shorts in a bull market? It's two. Head and shoulders, I'll draw them on. There's two. Okay. The first one is a head and shoulders. Now, this could be a head and shoulders goes across the side like that, or this could be a head and shoulders that has a rising neckline. There's the second one. Or this could be a head and shoulders with a declining neckline. Now, the most powerful of all those three is the declining neckline head and shoulders. They're all tradable, all good, but this ranks number one in our system, our ranking system, the way we look at it, as the best pattern to look for shorts in a bull market. That would be the first one. The second best one is a bear flag. Big drop, rally back up, another equally as good big drop. Both of these rank one and have an incredible amount of resilience in terms of shorting them. The third type of pattern are these upward channels or rising wedges. Ones that look like this, or or ones that look like this. One of the two of those. Now, both of these people sometimes get confused. They think, oh, look, this looks bullish because it's making higher highs and higher lows. Isn't that an uptrend? Well, yes, it's an uptrend, but it's not a bullish uptrend. These are all preceding usually a high probability of a breakdown. So a one touch, two touch, three touches on the bottom side of the support, and then breakdown. Same with an upward channel. One touch, two touch, three touch, break. And you can see that. So now we basically developed the starting point of what would we want to look for in a trading strategy. We want to look for a high probability pattern. So let me show you one of my favorites of recently, Activision. Now let's start with the daily chart. This was a great options or stock trade, no matter which you play. So ATVI, simple. We looked at the chart. We could see that we had a beautiful rising wedge formation where the stock just went higher and higher and higher in a contracting range. So as the stock peaks and we begin to roll over here, that was the entry criteria to consider picking up some March $45 puts. And as you can see, this thing just dumped all the way down to where those measurements were from that pattern. As you can see, the pattern tells it all. What were they doing? Fundamentally, who knows? Who cares? But they were in a very weak sector, a very weak industry, and what we cared about most was that the smart money was selling them, and they were a perfect bearish chart. So why not go ahead and do it also? There's one. Now, what we can also then do is we can tie in extra pieces of research to make this case even stronger. Okay, let's look at the actual insider selling of ATVI, and you'll see that we've got huge amounts of insider selling coming in just recently, unprecedented types of insider selling. Not surprising that the stock completely hit the gas in direction. Have a look at a few more examples. Look at Tupperware right now. This is kind of a new one, but it'll be on our watch list for quite a long time. Tupperware. There we go. You can see how much it wants to break down. You measure the top, the bottom of that rising wedge. I've probably given it even a bit more. Given this than I need to. There we go. Yeah, so that basically brings us back down to a target of around $43 on TUP. All it needs to clear is this kind of short-term support, which also just happens to be a head and shoulders inside this pattern, and now you've got a double whammy confirmed sell-off, right? And then you can go in, and once again, if you like to, look at the insider cows. And there you go. There's that unprecedented heavy amounts of sell-off. You see how cool this stuff is? This is really what This is really what we want you to be able to do. Because once you start to be able to scan for these things, it makes it easy. You just simply go to the chart, and it's a several step easy process. Let's use one more example. Here's another stock that we've recently alerted. You look at the chart and you think, okay, let's delete all these lines. You go left to right, and we start to figure out, what's this chart made of? Where are the correct lines? How do I know where to draw from? Am I drawing that? Or am I drawing this? Maybe they're all correct. What do I do? That? No. So first thing we do is we go left to right, and we establish our first reference point where we can know where we've actually figured something out that's true, that it works perfectly. So how do you know if you've answered the question correctly? It should work perfectly. You should have all of your bumps that are hit on the top and the bottom be right on the line, with very few exceptions of where it's actually broken through. And on those exceptions where it broke through, it will have been for something else, and we'll look for that. But for the purposes of now, we can go, if we need to go far enough back to April to see that, we've got a perfect line here, and when we duplicate that, that's a perfect downward channel. Would everyone agree that at least right there in the middle of the chart, we have found we are correct. We found the system that controls where that stock goes. Yeah? So, next, because we know where that pattern ends, now we know where the next one begins. So we then look for, okay, where to next? And we need to know where that starting point is. Right. So we rally up, we retest, and we start to build. Okay, we get a sharp upward channel. Upward channels, revert to the downside. Okay, and there's our reversion. New pattern starts here. So now we're looking for support. Okay, banding range there. Go up, we have an inverted scallop formation. We have an inverted scallop formation, is where basically you get a downward trend, or we flip it upside down, you get a downward trend followed by more than a 60-degree drop, and then a sharp rally. This could obviously be flipped upside down as well. And so in this case, you get the drop, the rally back, and then we start forming the upward move. At this point, you might see that the moving averages start to come into play. Barely, but they start to become a bit more relevant. And you start to see all this starts to switch back and forth. And we go over to here on the right hand side, we get this beautiful, nice, well formed drawing. There we go. All right, perfect. So we have an upward channel that just keeps rising and rising and rising. And when we zoom out and take a look at how this fills in the blanks, you'll start to see that there is a larger scale, head and shoulder that fits into us. There we go. Okay. So what is it? So this is beautiful because we kind of get what I call the Russian doll complex going on. When you start to open up one chart and you see larger time frames and larger patterns within smaller ones and so forth, it's kind of where the art of that jigsaw really comes into play. Um, as you can see here, what's happened is we've built this beautiful um, head and shoulder pattern, and it's just cresting, just stopping right here at this neckline, where it should then want to turn around and drop straight back down. Also, something that we look for as an almost immediate slam dunk type of opportunity. So these are all. There's so many different examples that I could show you. I mean, Cracker Barrel, Bear Flags. But this is what you have to figure out. I mean, once you know exactly what the pattern is, there's no guesswork anymore. There's no, I wonder if I'm going to be right. I hope I'm right. I'm scared that I'm wrong. Those all get eliminated because your only concern is, does it meet the rules? Am I following my rules? And um, and have I confirmed it with a good risk reward ratio? So I'm managing my account properly. Capital preservation is the number one thing in trading. Then making money is the second. Because if your capital is preserved, you'll always be able to make money. If you make silly decisions that risks your capital, that puts you behind the eight ball. So really, and then once we start to be able to design scans, we can start to read what the chart's telling us by looking for setups that are profitable for us. Um, Different charts all have different probabilities, and that's one of the biggest weaknesses that people have when they get into trading. They want to be focusing in on these high volumes of strategies, high volumes of indicators. What you really want to do is just knuckle down and focus on the best ones. What are the highest probability strategies out of the 100 plus that are out there, and how do you find those and trade those? Specialize. Um, in um, those small differences make the keys. Understanding the difference between a rising wedge, which breaks down, versus an ascending triangle. I mean, they're almost identical, but a rising wedge has highs that go higher, as well as lows that go higher, whereas an ascending triangle has equal highs but higher lows. Now, you'd think the one which had the higher highs as well would be more powerful, but it's the absolute opposite. So, understanding those small differences can often be the difference between making a great trade or a really bad one. The top ranking patterns that we follow the most are these: head and shoulder and inverted head and shoulder patterns, double tops and double bottoms, flag formations, ascending and descending triangles, continuation momentum trades, up and handles, bump and runs, bully bulls, things like these, and rising and falling wedges. A quick look again what these look like: bearish and oscillating, downward channel, upwards. bullish and oscillating often will be, again, you can see it's the same stock, just further on in its paddock. Double tops, oscillating. Now, again, and this is also important to understand the differences, because many of you might say, well, yes, I've traded a double top, I know what that is, but have you? You know, a double top can be a number of things. It can be a double top, Adam and Adam. It could be a double top, Adam and Eve. It could be a double top, Eve and Eve. It could be a double top, Eve and Adam. Now, there's only one of these four that you really ever want to trade, and it's this one. I mean, this ranks 13 out of 100 of tradable patterns. This one ranks 49. Why would you ever trade a lower probability hand when you have the choice of a much, much better one? Right? Because most people don't realize that they can choose. And so they just stick with, Tesla or Netflix or whatever that they are familiar with. But the chances of you having a perfect trade is slim to none. I could just pick any of these popular trades on a given day. What we want to see is we want to have the perfect trade setup. We want to have the perfect head and shoulder. We want to have let's say we're looking for a short. We want it to be a beautiful head and shoulder pattern. We want it to have, here's one of those, CERS. Now this is a smaller price stock. Here's another one, CERS, beautiful, declining neckline, head and shoulder. Insider selling. The rallied up on kind of fluff news, hit resistance and was just rolling over beautifully. Perfect type of head and shoulder. And you've got a resistance here, 560, with nothing to really catch it all the way down to 420. It's a $1.40, or almost 30%. I mean, these are the kinds of perfect hands that a card player would play every time. As a stock trader, we want to be able to try and limit ourselves to these opportunities also. So, I mean, you can see there's other high probability patterns here. Pennants. Pennants are fantastic. Flags. Flags are one of the highest ranking patterns as well, both bullish and bearish. And fallen angels. Fallen angels are an incredibly powerful strategy, one that is resilient in almost any market condition, just because of it's a purely momentum strategy that that I developed back in 2005, and was the first strategy I fully traded. It's what I built Acorn off of. In fact, for the first 2 years of Acorn, it's the only strategy we taught. In 2007, 2008, it was up to 70 to 80% probable finding longs as a scan, finding longs that were successful in a bear market. You, of course, remember what 2008 was like. Very powerful strategy, and that's looking for these big drops that then bounce at the bottom of the saucer. Again, bullish in momentum. Um, these types of these little sources, BCOR, call to run to a $7 run, pop straight back up. Again, you can see the moving averages taking play. So again, coming back to what people fail is a lack of these rules, a lack of being able to say, right, I only want to look at head and shoulders. I only want to look at head and shoulders, have the money flow coming out the back door. I want there to be a high to E ratio. I want the insiders to be selling. Oh, and not just that. I want to look at the insiders themselves, and I want them to be selling at a perfect time, in that I want every single time they sold in the past, the stock plummeted 20 or 30%. Let's make sure that if the insiders are selling, they have that bad of a track record, or good, depending which way you look at it. Let's make sure that they have a huge debt to equity ratio. Let's make sure that there's nothing good coming down the line. In fact, and so what you can see is I'm building like my recipe, a recipe of could it get any worse than this? Find me that stock. And when we teach this to our students in the Acorn course, a lot of students say, but John, how many times can you actually find something like that? Um, and if you, and the answer to that is enough. Enough times you can find these perfect storms. As long as you let go of having to trade Apple and figure out that tomorrow you might be trading a stock that, pardon me, that you've never heard of before. But hell, it trades $100 million a day, and all of those things I just mentioned are happening. So who cares whether you like the company or not? The smart money have clearly told us that they hate it and they're getting out. So um, this is kind of the big is teaching these strategies of how to read the chart with rules to tell you exactly when you're getting in and out and where to take profits or stop losses, but as well the scans that find those strategies. Um, this is a very special course we've just launched last and this is our this is kind of our most popular the course that I'm the most proud of over the course of the um, last 10 years we've been developing it really, and it's called Patterns and Probabilities or Powerful Patterns and Probabilities. This is an 8-module course, and you receive the on-demand version as well as live classes which kick off on December 8th, and there's basically every December, every Thursday and Monday, there'll be a class to complement the on-demand lessons. So it's 8 on-demand lessons and 8 live lessons. You'll have your own one-on-one coach assigned to you who will be working with you to implement, to learn, to study, to go through any kind of questions at all that you have. We'll be going through your own personal homework. So things like if you're wanting to look for a particular type of stock setup, we teach you how to do those scans and how to work with them. We also include you into our putting the trade together Oak Club portal, and these are standalone working modules that complement the course for you, which are hours and hours and hours of content we put together for our Oak Club, which are clients that have been with us for 5 years or more. We'll give you access to these videos, which will have capturing some of the scans I've been talking about, capturing the crash, finding flags course and scan. That's the flag plays. Also, the perfect storm scan, which is where we go in and actually find all of these stocks like Activision and stocks that we've been talking about before. There's advanced Fibonacci trading, candlestick patterns, options during earning strategy. So you're essentially getting access to all of this material. But the real essence, the real money maker here in the terms of the course content is focusing in on the patterns and probabilities and the scans to find them. That really is what my life's work has been all about. And I'm sure if you ask any of our students, they would agree that it is the where they've been able to get their biggest launch pad on how to get started. So again, those 8 modules go through the 6 most powerful patterns in the market, how to scan for them, the rules to trade them. Um, we even teach you the actual criteria so you can, if you want to add to or build on the scans we use, you can if you like. Um, one-on-one coaching. What we'll also be including is a special lesson tonight that we'll send out, which will be summarizing all of our favorite trade setups from this course, because we've been running this scan every night, sending you out our favorite trade setups from this course currently with options, stock entry and exit alerts that we're looking at, for you to be able to kickstart your trading career with us right from the go set. Okay. Now, if there are any questions at all, I'll put my email here on the address. We are also for anyone registering tonight. We will also be including a one-on-one power strategy lesson with me as an added bonus. So that's a great session where if you want, you can sit down with me and you, and we can go and run these scans and look for the best possible setups that night, possible trades tomorrow. And most of what I do, I love day trading, but most of what I do is set and forget. So I'll do my scans and research the night before, and it's down to a point now where I don't have to be anywhere near the computer to be trading at the level I was when I was looking at it 12 to 12 today. Computers are at that point you can fully automate everything these days. If the S&P breaks above here, do these 5 trades. If this trade triggers, cancel these trades. Like it's so easy to set up, and of course your time is valuable. So once you know how to automate something like this, why necessarily sit there and watch the grass grow? And with these patterns, that's exactly what that gives you, because you're able to really see, how much movement's realistic, and pre-program into your account for it to do it for you. Yeah, and the big bonus of that is if you don't always have to be forcing yourself to pull the trigger, you're less likely to make emotional mistakes where you don't, and you should have. Okay. Any questions, everyone? I think we're good. Okay. Well, thank you everyone for sticking around, and I'm glad you found it useful. Um, do I day trade the same way? Absolutely, absolutely. Um, the patterns and probabilities is what defines the entire the DNA of the market. It's how everything works inside. So you might see that you've got a certain pattern on a weekly chart, and then you zoom in, and on the daily chart, you've got a pattern, completely different pattern that gives you the same targets as the larger time frame. Then you narrow that into an hourly chart or a 15-minute chart, and you'll see that the on the 15-minute or the hourly, you've got a flag forming, and the flag formation suggests a target, which is exactly where your larger time frame chart has a target. It's amazing stuff. Amazing stuff. Flags are actually incredibly powerful. And look, if this is too much to bite off at once, and you just want to you just want to have uh, start off with one of our modules. You can start off with just learning flag formations, if you like. Those are for $97. That's an incredibly powerful strategy that's working very, very well at the moment. But um, but really, what if that's something you're interested in, just drop us an email. But I mean, I found that learning patterns is something that's going to allow you to have just unbelievable accuracy in being able to say this is where something will be next, and I'll have a 0.5% margin of error where I'll lose if I'm wrong, but I'll make 10% if I'm right. Like it gives you that level of confidence to be able to execute trades without worrying if you're right or wrong, because it's a totally understood risk that's not based on guesswork, but based on thousands of other traders before you that have traded these and set these up and back tested, to put that work in. So yes, I absolutely trade the same way. All right. Okay, well, it looks like we're at the end of tonight. So, yeah, once again, thank you everybody for coming. And of course, the link's up on the screen there, acornwealthcorp.com/power. And look forward to seeing you all here in the upcoming live lessons. Have a wonderful night.